Welcome back, wealth builders. Michael Rosmer here with Richucation. We're talking today about the subject of liquidity. Okay, and liquidity is pretty important when we're considering assets. So, liquidity. What does liquidity mean? Liquidity means that you can get your money out. Okay, so we're going to talk about liquidity and cash flow. All right, because what you'll find when you have, various different investments, various different assets, etc., is some are not liquid and some are. So as an example, let's say we buy a private business versus buy a public company. The advantage of owning a public company's shares is you have liquidity, right? Meaning that I can go and I can sell them on the general market tomorrow, right? Assuming there's, enough liquidity in the market, which there usually is, right? Unless you're very large or the market is very small or something like that. Usually you can sell fairly easily. If you have a reasonable amount of money in a very small company, then that could affect the share value as you sell, of course. Or if you're very big, if you're Warren Buffett and you're selling your shares of Coca-Cola, that can affect the share value, right? Because you own a pretty substantial portion of it. So liquidity and cash flow, all right? So liquidity is the ability to sell, basically really quickly, right? So as an example, real estate is a relatively illiquid asset, okay? Meaning that it takes some time to get your money out. Usually you're talking about, weeks or months usually is the time period, okay? Cash flow is, you're getting paid by it. So instead of, as an example, if I have an asset and it's, producing some sort of a return, sometimes that return is internal and sometimes it's paid out to me, right? So this is an example of when companies pay dividends, when interest payments are paid monthly or quarterly, etc. Royalties might be paid regularly, etc. Okay? So these things are good in one sense, okay? Liquidity and cash flow tend to decrease risk, okay? And how come they decrease risk? Well, they allow you, if something starts to go wrong, they allow you to get out, right? And if there's cash flow, as you're collecting the cash flow, you're at least getting a return. I'll give you a contrasting example. Two investments back in 2008 or something. One was a real estate investment, it was a real estate development project. Another one was an investment in, I forget what the term they used was, but I believe the less common term is viaticals. And this is where they're buying life insurance policies from people who are going to die, thereby giving them some sort of a return, right? So that those people have liquidity, and then you're turning around and that they're going to pay out when the person dies. Okay, this is the idea. Now, whatever they called it, life something or other, okay, paid out monthly, okay? So it was like a 10% a year rate of return paid monthly, so a little less than 1% a month, and the other one did not, okay? Both 100% loss for investors, okay? So both went to zero. But at least the life insurance one paid its monthly payments for like a year or something before it went bust, okay? So at least whoever invested collected 10% of their money back. So their loss was really 90% plus the time value of the money. Whereas in the other one, it was 100% plus the time value of the money, right? So that's one way cash flow decreases risk, and then liquidity, of course, if you can see things going bad, you can sell out, great. That's more effective. Another thing, it might not be that it's going bad, it might be that you need the money, right? It might be something that's changed in your life. You're like, hey, my kids are going to college or university, so we need the $20,000, $50,000, whatever it is to pay for their college and university. Or maybe, you have some sort of a medical emergency, or, who knows what happens, but you suddenly need the money. And if you suddenly need the money, then if you don't have a reserve fund, which if you go and look at our common, we have our little formula for people that we give them on terms of building wealth, we mentioned build a reserve fund, right? Because you don't want to be caught in that position where, hey, the market goes down and all of a sudden you have to sell. This happened to my brother. My parents had invested some money for him for an education fund, and it just happened that when he was going to school, the market was at its all-time low sort of thing, right? Well, that really sucks, right? It was, I believe it was like March 2009 or something, and they had to pay his tuition, and the markets had just fallen like 40% or some ridiculous amount. So that's an example of where if you have, well, imagine this. Imagine you need the money and you don't have liquidity. Okay, so that, in that case, at least there's liquidity, but you're in a position where it's like, well, the market's going down. So say what I have is a house. Okay, so I've got a piece of property. Let's say the house is worth $500,000. All right, say I own it clear title just for the sake of argument. Okay, so there's $500,000 available there, and some emergency comes up. I need cash. Okay, and I need it like really fast, like in a week. Okay, can I get some money out of that house? Yes, I can. However, to get that money out of that house, because I need the money quickly, I will probably have to take a loss. What I mean by take a loss is either I'm going to have to, like, if you're willing to sell a property for low enough, you can close just like that. Okay, there are people out there who will buy your property for a sufficient amount below market value if you need to sell quickly, because they're going to make up that difference, right? So you say, hey, look, I'm willing to sell 20% below appraised value, but I have to close this week. Okay? There's some people who will do that deal, right? Especially if it's 30, whatever the percentage is, right? But notice you lost 20%. On the flip side, maybe you say, okay, well, I can get a loan against it, right? Now, normally, I could get a loan and, I can walk into a bank, I can get a loan for, let's call it 3%, right? Right now, maybe it's 2.5%. Some parts of the world, it's obviously a lot higher, depends on where you are, right? But where I am right now, it's about 2.5%. But, we're going to have to go through this due diligence process, we have to blah, blah, blah. By the time I get the money, might be 2 weeks, might be, I'm just throwing around numbers here to give this sense of, like, if you urgently need the money, can you go and get it if you have the asset? Yes, you can. But the cost of getting it is going to go up, all right? Meaning that, as an example, somebody will say, okay, like I might do this deal for you and say, okay, you have this clear title asset, I'll put a first mortgage on that property, so I know I'm taken care of, I'm protected, and I will lend you the money, but here's the deal, I'm going to charge you a transaction fee of 4%, and I'm going to charge you 1% a month for a 6-month mortgage, and there's a penalty if you pay it out earlier, something like that, right? So now I'm going to get 10% on my money for 6 months, and I'm lending it at like 50% loan to value. What can you do? You can walk into a bank, and you can go and you can get a mortgage, and you can buy out that mortgage that I have in, and so, but you just paid 10% for this money when normally you could have paid, let's say it was 3%, so you're talking about 1 or half of 3%, 1.5%, right? So it just cost you 8% basically to go and get that money, all right? All because you didn't have liquidity. And so there's different strategies you can use to put liquidity in place. For example, you can set up a line of credit in advance against an asset that you have, okay? That way, you might never use it, right? It could just sit there for days, months, years, right? But if you ever need it, you have it available, right? So, okay, I have this line of credit available. And you could get that against all kinds of assets, right? So that's one thing to do. The next thing is you can, of course, buy assets that have liquidity in them, right? And there's varying degrees of how much liquidity you can get. So as an example, businesses are typically going to have less liquidity than real estate, which is going to have less liquidity than public market stocks or bonds, okay? Now, here's the thing to understand. So typically, usually, not always, but usually to have liquidity or cash flow, you either pay, you have a premium, or a penalty, okay? What does that mean? Well, usually if I'm paying you cash flow, then I'm going to give you a lower rate of return, all right? So as an example, you could have what's called a balloon interest payment, right, where the interest is all paid out at the end. Usually then you'll get a slightly better rate of return. Versus if you're getting monthly payments, it's going to be a lower rate of return, okay? Usually, not necessarily, but there's some reasons for that. So let's look at, the math of how come this is. Let's say that you lend me money, okay, on a project. So it's what's called a mortgage investment corporation, a MIC, okay? And so you provide this loan, which is like you invest this money, and let's say that we promise you a 10% rate of return, okay? So you might say, or let's say it's 8%, okay? So in order to pay you 8%, what do I need to get? Well, first of all, I need to turn around and I need to make more than 8% because I have to cover the administration fees of all this, right? All the the administration fees, the legal, etc. Plus, I have to make a profit, right? So we're already, depending on the volume of money, etc., meaning that I probably have to lend that money out at 10 to 12%, okay? In addition to that, very often there's some sort of a fee paid, okay? So let's say that there is a 10% fee to raise the money, okay? So there's $100,000, okay, 100K, and now I have to pay you $108,000 at the end of a year is the theory, or let's call it, it's $108,000, but we could multiply it out by multiple years, right? So $108K. But so you'd say, okay, well I have to invest this $100,000, I have to get an 8% rate of return, right? No, wrong. Because in addition to the fact that I need that profit, etc., which means that I probably need to bring this up to at least $112,000, I also lost $10,000 that I paid to raise that money. Okay, 10K. Which means what I've really got is $90,000, okay? And I have to invest $90,000 to get out this. Well, is it very feasible for me to be able to provide you with liquidity and cash flow in that scenario? So I have to pay you out $8,000 this year based on $90,000. So right off the top, that's not 8%, that's closer to 10%, right? And I'm expected to pay, whatever else, right? So if you give me this over a 3-year term where you don't have liquidity and you don't have cash flow, then what that allows me to do is it allows me to go, okay, because I don't have to pay that money out, I can reinvest it and compound it, right? So let's say that I'm paying out, I don't know, let's call it, I'm getting 14% on the money, right? So $90,000, 14%, and I do that 3 years in a row, so it compounds. Then at the end, I may be able to make up this difference. Right? That's probably about what the numbers work out. I haven't run the math recently on these, but the whole point is that's why if you say, hey, come to me, you go, oh, okay, look, I really need this money. I'm going to have to sell out. Okay, well, I'm going to charge you a penalty because we had to pay this fee, and normally we were going to pay that fee off over the course of 3 years, which was going to add up to, approximately $3,000 a year, which is basically 3%, right? So you can kind of figure, I guess that puts us up to around 15% a year, right? So because of that, I'm going to knock you down. Yeah, we'll redeem it for you, but we're going to do it at $90,000, not at $100,000, okay? It's a penalty. And the cash flow, usually if you're getting monthly payments, then I'm probably going to, because of how I have to work these numbers, I'm going to knock it down. Instead of paying you 8% a year, I'll pay you 6% a year or something like that. So it's 0.5% a month, right? This kind of thing. If you have bonds, very often, like government bonds are liquid. You can sell them, okay? But very frequently, you'll pay a penalty if you do. And the penalty would be, as an example, you forfeit the interest for the year. So say interest is paid out annually, right? So it's like a 7-year bond, right? And every year you get payment of interest. Let's say that was how it worked, okay? And you happen to sell halfway through the year, well, you're going to not collect your interest for that year, as an example, okay? So this is just the important thing to realize is, yes, liquidity and cash flow do, in theory, decrease your risk. Yes, there's a good place to have it, but it's also typically going to diminish your returns because you're going to pay a premium for that or pay a penalty. Not always, but often, okay? And you can even see this with businesses, because what will often happen is that companies that are paying high dividends generally have less growth, all right? And the reason for that is because they aren't able to reinvest their money as efficiently, Okay, so like Warren Buffett talks quite a bit about how he's looking for the ability to reinvest the capital efficiently in order to grow the company. Okay, so that's where one of our metrics of return on equity comes in. Hope that helps. Hope that gives you guys a great idea of what it is that we're talking about when we're talking about liquidity and cash flow. There's pros and cons to it. It's something you should definitely be aware of with respect to your assets. What we always advise is we say when you're getting started, ideally, if possible, go for liquid assets. Because what if something goes wrong, right? But then as you get more mature in your investing life, you don't have that need, you've got a reserve fund, you've got whatever, you have some liquidity, now you can focus on things that are less liquid, right? And frequently the things that are less liquid that don't have cash flow frequently provide better performance. Although we're going to talk about that, or we did talk about that in the section on return on equity, or return on invested capital, sorry. Hope that helps. We'll see you guys on the next video.